and welcome to the session of Accounting for Partnership and Introduction. In this session, we will cover 7 topics in total. That is introduction. Then we will talk about what is partnership, its features, types of partners and all. Then we will discuss a couple of things about accounting for partnership. That means that will cover that in this session, that how accounting for partnership is different from accounting for a sole proprietorship firm or for a non-profit organization. Then we will talk about treatment of capital, treatment of drawings, some other calculations like calculations related to commission to a manager or commission to a partner. And finally, we will talk about past adjustments. And in this section related to past adjustments, we will discuss about why past adjustments are required and what are the different ways and means of doing the past adjustments. In order to break this session in logical segments, we will have 3 different videos coming up in this series. That is accounting for partnership and introduction. And in our first video, we will take up the first 3 topics, that is introduction, what is partnership and accounting for partnership. In the second video of this series, we will talk about treatment of capital and treatment of drawings. And in the final video of this series, we will talk about other calculations and past adjustments. So without wasting any time, let's begin. So if we talk about types of business undertakings for our understanding, then this slide presents a brief overview of what are the different types of business undertakings in India and in which category they falls. So to begin with, if we look at the human activities, then the human activities can be broadly classified into 2 categories, that is non-economic activities and economic activities. The economic activities can be further subdivided into 3 categories, that is business, profession, and employment. All the business undertakings bases their ownership can be divided into 3 subcategories, that is private sector, public sector, or joint sector. The different business undertakings falling in the category of private sector, depending on their setup or depending on the type of ownership the business undertaking is having, these private sector business undertakings or business entities can be classified into 5 different categories. That is sole proprietorship, joint Hindu family business, partnership, cooperative society, and company. And when we talk about partnership firms, then depending on the type of partnership they are having or the relationship the partners are having, the partnership firms can be classified into 4 categories, that is general partnership, limited partnership, limited liability partnership, limited liability, limited partnership. So if we look from the accounting standpoint, there are no major differences, and we will be focusing mainly on accounting for general partnership. Let's move on. On this slide, we have tried to present a brief introduction about the partnership firm. So when 2 or more people join together to carry out a business, those 2 individuals are individually called as partners, and collectively they are known as partnership firm. And all the partnership firms or all the businesses carried out in India as partnership are governed by the Indian Partnership Act of 1932, which states that there should be at least 2 persons or 2 individuals carrying out a business in common. And the maximum number of partners that a partnership firm can have, 20 in case of normal business. And if the partnership firm is carrying out business in banking sector, then the maximum number of partners that can join the firm is 10. So for banking, for carrying out business of banking sector, the maximum number of partners is 10, and for any other type of business, the maximum number of partners is 20. Then depending on the number of partners and their agreement, the partners agree on different subjects like how much capital each partner would contribute, in what ratio they would be sharing the profits, who will be working as an active partner, so on and so forth. So in the subsequent slides, we will talk about the features of partnership in detail. So this is just a quick snapshot. Moving further, now let's understand partnership better. Like now let's try and analyze the definition of partnership. So the answer to this question, that what is partnership? You can say a form of doing business where two or more than two individuals agrees to pool in their resources for undertaking a business activity, thereby agreeing to share the responsibility of management, profit or losses, and ownership. This is how you can define the partnership. So depending on this definition, we can, there are a couple of things which are very clear from the definition. The first one is two or more than two individuals. So if one person is carrying out a business and if he claims that I'm carrying out the business as partnership, no, that's not possible. There should be at least two or more than two individuals carrying out the business. And in partnership firm, the two or more than two individuals who agree to carry out the business in common or carry out the business together, they agree to pool in their resources. Now, by pooling in their resources, what we mean, don't strictly mean that all the partners would be contributing capital or money in the business. If one partner has the technical knowledge and the other partner is bringing in the capital, so there are two resources, the technical knowledge and the capital, coming together to carry out that business. So when we talk, when we say pooling in their resources, essentially does not mean that both the partners are contributing capital or contributing money in the business. And they agree to share the responsibility of management, profit or losses, and ownership. That means when the partners have agreed to carry out a business in partnership or in common, then all the partners are responsible to manage the business. They have agreed to share the profits or losses and the ownership. So all the partners are joint owner of all the assets of the partnership firm. It is not that one partner owns all the assets, or out of say 4 or 5 partners, 2 or 3 partners own all the assets, or uh, the responsibility of managing the entire business is on 1 or 2 partners. All the partners are collectively responsible for managing the business. They have agreed to share the profits and losses in an agreed ratio, and they are the joint owners of the partnership business. Now, depending on this definition of partnership, if we talk about the characteristics of partnership, then there are always 2 or more than 2 people. Then there is an agreement in terms of like how how much capital each partner will contribute, or in what form or shape the capital would be contributed, who will be managing the day-to-day business of the firm, who would be taking an active participation in the process of managing the business, in what ratio they would be sharing the profits and losses, so on and so forth. So there is an agreement. Existence of business and profit motive. Whenever we are saying that we are forming a partnership firm, then the basic objective of any partnership firm is to run a business with a motive of earning profit. Then sharing of profit. The profit may be shared in any proportion. Like, for example, if there are two partners and if they decide to share the profit and losses in the ratio of 1:99, that is fine. But there will always be sharing of profit. If we see a situation where the partners, they are saying that we are running a business in partnership, okay, and one partner tells to the other partner that, okay, I will pay you 10,000 rupees per month, and whatever rest of the profit is, that is mine. So here it is not sharing of profit. It is a kind of a salary there or a compensation you are giving to the partner. So more the profit, the more the share would be. The lesser the profit, the lesser the share would be. So normally there is a sharing of profit among the partners in a partnership firm. Relationship of principal and agent. As we discussed earlier, the maximum number of partners can be 20 in a partnership firm. And just imagine a situation where the partnership firm wants to issue a check to a third party. Then all the 20 partners cannot do their signatures on the check. So in that inside such cases, what happens is partners in their agreement states it very clearly that who are the authorized signatories for the partnership firm. That means the people who are authorized to do signatures or entering into a contract with third party on behalf of the partnership firm, they are acting as agent of the partnership firm. And as the partnership firm is giving them this authority to uh, be the authorized signatory of the partnership firm or to agree into contract with a third party, uh, so the partnership firm is the principal. So there is an existence of relationship of principal and agent. And in this case, the partnership firm is the principal, and the partners who are authorized to do signatures on behalf of partnership firm or who are authorized to enter into contract with third party on behalf of the partnership firm are the agents. Then the business may be carried on by all or anyone acting for all. This is again part of the partnership agreement. Again, going back to the same example, we are running a business of restaurant, and there are 20 partners in the firm who is managing that restaurant. Then all the 20 partners cannot be sitting at the restaurant throughout the day. Or if we are running a grocery shop in partnership and there are 5 partners, all the 5 partners cannot be sitting at the grocery shop. So in such cases, what happens is, as per the agreement, one partner may be acting on behalf of all the other partners. Whereas, as per the Indian Partnership Act of 1932, all the partners are eligible or all the partners are authorized to take active participation in managing the day-to-day affairs of the business. But depending on the situation, depending on the requirements of the business, and as per the agreement among the partners, all the partners may take active participation in managing the day-to-day affairs of the business, or one partner may be acting on behalf of all the partners and taking active participation in managing the day-to-day activities of the business. The last feature or characteristics of partnership firm is that partnership firm doesn't have a separate existence from its partners. By this, what is meant is, if the partnership firm suffers a loss and the assets of the partnership firm are not sufficient enough to meet that loss, then even the personal assets of the partners can be seized or can be utilized to meet that loss. So partnership firm and partners don't have a separate existence. Now let's look at the rights of the partners. Every partner has the right to share profit and loss with other partners in agreed ratio. This is what I have already told you, that all the partners of a partnership firm are entitled to have their share in profit or loss in the agreed ratio. Every partner has the right to take part in the conduct of the business. So if there are four partners and if all four of them wants to take active participation in managing the day-to-day affairs of the business, then all the four partners can do it. The three partners cannot ask one partner that no, you are not supposed to take active participation in the in managing the affairs of the business on day-to-day basis. Every partner has the right. But if they agree on, if they have an agreement among themselves that out of four partners, one partner will manage the day-to-day activities of the business, that is fine. That is absolutely basis on the agreement. But as per law, any partner cannot be denied of the right of managing the day-to-day affairs of the business or taking active participation in conducting the business. Every partner has right to be consulted in matters related to partnership form. All the partners should be consulted while taking important decisions in regard to the business. Say, for example, if a partnership firm is running a business of restaurant and they were serving the North Indian cuisines in their restaurant, and the partner who was actually managing the day-to-day day-to-day matters of the restaurant has observed that their customers are asking for Chinese cuisines, then whether to introduce Chinese cuisines in the menu of restaurant or not, it's a policy decision from the restaurant's standpoint. So all the partners must be consulted before adding the Chinese cuisines to the menu of the restaurant. Next is every partner has right to inspect and have a copy of books of accounts. So one person is managing the day-to-day affairs of the business and other partners are not taking active participation. So whenever any partner wants, he has the right to go through the books of accounts, and if needed, he can take a copy of books of accounts. Any partner cannot be denied to have access to the books of accounts. Then next is every partner has right to disallow the admission of a new partner. So for example, a partnership firm is already existing and four partners are carrying out the business. And if one partner proposes to bring in a new partner, then all the other partners, all the three partners should agree. Then only a new partner can be admitted. If any of the partner denies or disallows the admission of a new partner, the new partner obviously cannot be entered into that partnership firm. Every partner has the right to retire from the firm after giving a proper notice. So a partnership firm which has been in existence for say last 30 years, and one partner decides that, okay, it's enough and he want to do something else in life, or he want to enjoy a retired life. So he wants to quit the partnership firm. He can, yes, very well do it. But before doing it, he must give a proper notice to all the partners. No one can do it like this, that, okay, today I decided that I don't want to continue in the partnership firm, and from tomorrow I stop working for the partnership firm, or I consider myself as out of that partnership firm from tomorrow morning itself. No, that's not possible. If I want to exit from a partnership firm, I will have to give proper prior notice to all the other partners of the partnership firm. Then every partner is the joint owner of partnership property. So whatever assets are owned by the partnership firm, they are in the of joint ownership. All the partners are equal owner of all the assets owned by the partnership firm. The assets of partnership firm are not individually owned by any of the partners. Then if a partner gives a loan to a firm, he has a right to receive interest as at agreed rate. And if the rate of interest is not agreed, it is paid at a rate of 6% per annum. So at times, the partnership firm may need some additional funds. And if any partner provides that additional fund as a loan to the partnership firm, then he has all the rights to receive an interest on that loan, which the partner has advanced to the partnership firm at the agreed rate, whatever the rate has been agreed. And if there is no agreement in terms of at what rate the interest would be provided to the partner who has advanced loan to the partnership firm, then by default he will get a interest of 6% per annum. This is as per the provisions of Indian Partnership Act of 1932. And lastly, if a partner incurs expense or make payments on behalf of the firm, he has a right to be indemnified by the firm. That means if a partner pays any bill of partnership firm from his own pocket or from his own assets, then the partner is supposed to get reimbursement for that amount, the amount that he has paid on behalf of the partnership firm. So these are some of the rights that each partner of any partnership firm operating in India enjoys. Now, let's have a quick look about the types of partners. So depending on the status or depending on the activities in which how the partners are working, the partners can be classified as active partner or managing partner. These are actually the partners who are running the business on day-to-day basis. So as I told you earlier, if the partners agree, then one partner can take one or two partner can take active participation in managing the day-to-day business of the partnership firm, and other partners may be a sleeping partner or a dormant partner. They may not be taking active participation. So the partners who are actually managing the day-to-day affairs of the partnership firm are known as active partners or managing partners. Then we have got dormant partners or sleeping partners. So these are the partners who has actually contributed capital or they have contributed their resources in managing in the partnership firm, but they are not taking active participation in the day-to-day management of activities of partnership firm. So they are termed as dormant partners or sleeping partners. But remember this thing, the rights of any partner are not decided by their status. All the partners of partnership firm has all the rights which we have discussed on the previous slide. So it don't get confused that active partners will have more rights as compared to a dormant or a sleeping partner. Then when we talk about nominal partners, so these are the partners who have actually not contributed any capital in the partnership firm, but they have just lent their name. So there may be a businessman who is having a very good reputation in the market, and somebody wants to establish a business just to enjoy a goodwill in the market or have a better standing in the market from the day one itself. They can reach to that businessman saying that, okay, please lend us your name and we will tell everyone that you are partner in our firm. So they are just partner for the namesake. They don't contribute any capital. They just lend their name to the partnership firm. Then we have got partner by estoppel. Partner by estoppel are those partners who are actually not partners in a partnership firm, but they give an impression to the outside world that they are partners in a partnership firm. But these partners may be held responsible for any debt or any kind of liability of the partnership firm if they have imposed themselves or they have presented themselves as partner in a partnership firm to the outside world. Then partners in profits only. At times we have such partners also in a partnership firm who are partners in profits only, and these are those partners if who will not bear any share in losses. Say for example, if there is a person who is having sufficient capital and want to want to start a business of, say, um, uh, some technology in some technology. So that person who is having the money don't have uh, that technical expertise. He approaches a person having the required technical expertise and asks him to join him as a partner in the business. But the person who is having the technical knowledge says that, sorry, I am not going to be a partner because I am not in that position that I can bear the losses. So in such cases, it can be offered that, okay, what you can be partner in profit only. So whenever the firm is earning any profit, the person will get a share in the profit. But if there are losses, then the losses would be borne by the other partners. So in this case, the only difference between the normal partners and partners in profit is that the partners in profit will take his share in the profits only. But if there is any loss, then the loss will be borne by the other partners of the partnership firm. Then minor partner. The life is very uncertain, and there may be circumstances where a partner who is, say, for example, a partner expires. And now uh, the other partners decides that someone from the family of the deceased partner should be introduced as a partner in the partnership firm. But the person whom they are intending to introduce in the partnership firm as a partner has not attained the age of 18 years. But still, he has been appointed as a partner, then he would be considered as a minor partner. And there are some special provisions to protect the interest of a minor partner. Number one, minor partner will only be entitled to get his or her share in profits only. The minor partner will never ever get his share of losses. Secondly, when the minor partner attains the age of 18 years, then an option will be given to the minor partner that whether he want to continue in the partnership firm as a normal partner, or if he wants, he can, if he or she wants, then they can, he or she can opt to step out of the partnership. So these are the two special provisions in case of minor partner. Number one, minor partner will only have share in the profits. He will not have share in the losses of the partnership firm. And secondly, when the minor partner attains the age of 18 years, an option will be given to him or her that whether they want to continue in the partnership firm or they want to step out of the partnership firm. So these are the different types of partners. So with that, let's move on to the next topic. Let's do a deep dive and understand. Understand in detail what is partners, what is partnership firm, and what is partnership deed. Excuse me. Now, partners, an individual who shares or is associated with another person in some business activity and agrees to share its risk and profits is known as partner. If we talk about partnership firm, the group of partners carrying out business in common and sharing the risk associated and profits earned is collectively known as partnership firm, or they are normally referred as firm. So when we talk about individuals, then they are called partners. And when we collectively refer to a group of partners who are carrying out business in common, then it is known as partnership firm. When we talk about partnership deed, then it is a document containing the provisions, terms, and conditions governing the relationship among the partners of the firm. So when two or more than two people are doing something in common, then there should be some agreement, there should be some ground rules set up, how the relationship will work, what will be the roles and responsibilities of each and every individual. What are some of the do's and don'ts? So that is what the partnership deed contains. So it's a document, or you can say it's the constitution that governs the partnership firm. Now, let's look in detail what a partnership deed contains. So the contents of partnership deed are name and address of the firm, name and address of the partners, the type and nature of the business the firm proposes to do, that what type of business it will do, whether it will be in the manufacturing sector or it will be in the trading sector. If in manufacturing sector, what it is going to manufacture, and if it is in trading, what type of trade it's going to do, so on and so forth. Then amount of capital to be contributed by each partner, the amount of capital. Here, the amount of capital not only means in monetary terms, but in some cases, the partners may say that, okay, instead of contributing capital, I will provide my land to the partnership firm, or I will give my machinery to the partnership firm, or I will provide the raw material to the partnership firm. But it will be again expressed in terms of money. So what will be the contribution of each partner? Then interest on capitals. Whether the first question it needs to answer is whether the interest on capital will be provided or not. If yes, then at what rate interest on capital would be provided? Are drawings allowed or not? If drawings are allowed, then to what extent the drawings would be allowed, on what frequency the drawings can be done, and at what rate the interest on drawings would be charged. Then what would be the profit sharing ratio? Then is any partner entitled to get any salary? If yes, what would be the amount? How the goodwill of the partnership firm will be calculated? Whether in first place, whether they will have goodwill in their balance sheet or not. If yes, then how the goodwill would be calculated or valued? What would be the accounting period of the firm? Method of recording firm's account. Then how the auditing would be conducted, who are authorized to conduct the auditing. Then date of commencement of the partnership. Then duration of the partnership. At times, some partnership are done for a specified period. So if yes, then what would be the duration of the partnership firm? Use of the decision in terms of Garner versus Murray. So this is a concept that we would study in detail in subsequent chapter, subsequent section or subsequent session. Then bank accounts, with which bank the partnership firm will have the bank accounts, who will be the authorized signatory in the bank, so on and so forth. Then rules to be followed in case of admission of a partner. Earlier, we discussed that all the partners should agree, but again, the partners may agree that, okay, with 2/3 majority or a majority wins or whatever the case may be. So depending on the thought process of the partners, it can be decided that what rules needs to be followed in case of admission of a new partner. Rules to be followed while settling the accounts on retirement. If we discussed earlier that any partner may retire from the partnership firm after giving a proper notice. So if any partner is retiring from the firm, then how his account would be settled, whether the entire amount would be paid in one go or it would be paid in installments. If it is paid in installments, whether any interest would be provided on the amount which is retained in the firm. So provisions related to what rules needs to be followed while settling the account on retirement of a partner. Then settlement of disputes. If there is any dispute among the partners, then how those disputes would be settled. So basically, these are the 20 points which normally any partnership deed would contain. But again, remember, these are simple guidelines. It is not mandatory that a partnership deed should have all these 20 pointers. The partnership deed may have all these 20 pointers and there may be some additional things, but these are the suggestions or these are the pointers that any partnership deed ideally should contain. If the partners want to decide that, okay, they will not talk anything about the goodwill, or they will not talk anything about the profit sharing ratio or interest on capital or any other point, then also that they can create a partnership deed, leaving aside some of the pointers uh, as per their agreement. Now, why partnership deed is required? Because earlier we discussed in some of the earlier slides that it is not mandatory to have a partnership deed. And here we have spoken in detail about the partnership deed. What are the contents of a partnership deed? Now the question arises, why partnership deed is required? So first of all, the partnership deed is required that it regulates the rights, duties, and liabilities of each partner. It helps to avoid any misunderstanding among the partners. So these are the, in addition to this, any dispute among the partners may be settled easily basis the partnership deed. Because when we start something new, everyone is very happy, everyone is very enthusiastic, and we fail to look at some of the pointers. But at a later stage, if there is any dispute, then everyone wants to prove himself himself or his point of view as correct. So in order to avoid all these situations, the best thing is to have a partnership deed in place. And this partnership deeds helps a lot in smooth functioning or seamless functioning of the partnership firm. So that's more or less about the introduction of about partnership firm, or what a partnership type of business looks like for partnership. So when we talk about accounting for partnership, then there are some provisions relevant for partnership accounting. First one is profit sharing ratio. If the partnership deed is silent about profit sharing ratio, the profits and losses of the firm are to be shared equally by the partners, irrespective of their capital contribution in the firm. That's why, again, going back to the same point, the partnership deed. If we have a partnership deed, then in partnership deed, we should be clearly mentioning that in what ratio the profit and losses would be shared among the partners. There may be situations where the partnership deed is either not present, or the partnership deed is present, but it has no mention of the profit sharing ratio. Then irrespective of what is the capital contributed by each partner, how much involvement each partner has in managing the day-to-day affairs of the business, disregarding all these factors, the profit and losses would be shared by all the partners equally. Then next is interest on capital. If there is no partnership deed, or the partnership deed is silent about interest on capital, then no partner is entitled to get any interest on the amount invested in the partnership firm as capital. So no interest on capital if it is not mentioned in partnership deed, or the partnership deed is silent about interest on capital. Interest on drawings. If the partnership deed is silent about interest on drawings, then no interest on drawings would be charged at all. Interest on advances. If a partner gives a certain amount to the partnership firm as a loan, then even though there is no partnership deed, or the partnership deed is silent about interest on loan by a partner to the partnership firm, then also the partner is entitled to get interest on the loan amount at the rate of 6% per annum. Then remuneration for firm's work. We discussed about types of partners, the active partner versus sleeping partners or the dormant partners. So if they are sharing profit and losses equally, but the partner who is taking active participation in managing the day-to-day affairs of the partnership firm, then obviously he is putting in more effort. So should be remunerated for the services or the work he is doing for the partnership firm. But if the partnership deed is not there, or if the partnership deed is silent about any such remuneration, then no partner is entitled to get any remuneration for the work he has done for the firm. No matter he is spending 18 hours, 20 hours on a daily basis in managing the uh, day-to-day affairs of the partnership firm, and ultimately sharing the profit and losses in the equal ratio, then also the partner is not entitled to get any kind of remuneration. The next is, if the partner derives any profit for him or herself from any transaction of the firm, or for the use of from the use of property or business connections of the firm or their name, he or she shall account for the profit and pay it to the firm. Say, for example, if a partner uh, engaged in a engaged in any kind of business gets some benefit because because of the virtue of being partner of that partnership firm, then he is supposed to disclose that information to the partnership firm and should pay the amount of profit that he has earned out of because of this transaction. And lastly, if a partner carries on any business of the same nature as and competing with that of the firm, he or she shall account for and pay to the firm all profits made by him or her in that business. Say, for example, any partner who is carrying out the business of same nature, uh, like I'm partner in a partnership firm running a restaurant business, and I am again running my own restaurant apart from the restaurant of my partnership firm. Then I shall account for and pay to the firm all the profits made by me in that particular business. So whatever profit I'm earning from my personal restaurant, I should disclose that information to the partnership firm, and I should pay that profit to the partnership firm. So these are some of the provisions relevant for accounting of a partnership firm. Now, just to give you a quick snapshot of what are the rules applicable in absence of partnership deed. And when we say that in absence of partnership deed, it not only means that there is no partnership deed at all, but it also means that there is a partnership deed, but that partnership deed is silent on any of these 8 points. So the first one is profit sharing ratio. If there is no partnership deed, or the partnership deed is silent about the profit sharing ratio, then the profits would be shared equally by all the partners. Interest on capitals and interest on drawings. If there is no partnership deed, or the partnership deed is silent on interest on capital and interest on drawings, then no interest on capital would be provided to the partners, and no interest on drawings would be charged to the partners. Interest on loan from a partner. If there is no partnership deed, or the partnership deed is silent, then any amount provided by the partner as loan to the partnership firm, then the partnership firm is liable to pay interest at the rate of 6% per annum to the partner on the amount that has been advanced to the partnership firm as loan. Salary to the partner. If there is no partnership deed, or the partnership deed is silent about any type of salary or commission payable to the partners for their contribution in the business, then they are not entitled or eligible to get any kind of salary or commission. Admission of a new partner. When all the partners agree, then only a new partner can be agreed. A new partner can be entered in the partnership firm. If the partnership, there is no partnership deed, or if the partnership deed is silent about the rules in regard to admission of a new partner. Conducting of business. that is taking active participation in managing the day-to-day affairs of the business. If there is no partnership deed or the partnership deed is silent, then all the partners can take active participation in managing the day-to-day business of the partnership firm. Inspecting the books of accounts, all the partners can inspect the books of accounts and can take a copy of the books of accounts if there is no partnership deed or partnership deed is silent in this regard. Moving on, let's have a quick look at the accounting cycle for the sole proprietorship firm. So in sole proprietorship firm, the first thing that we do is passing the journal entries, which are actually the original entries of the transactions. Then we prepare the ledger accounts, which is classification of transactions. Then after ledger accounts, we prepare the trial balance, which is nothing but list of account balances. Using the trial balance, we prepare the trading account, which discloses the gross profit. Then after that, we prepare the profit and loss account, which helps us to ascertain the net profit earned by the business. And finally, we prepare the balance sheet, which shows the financial status of the business. So this is the accounting cycle, high-level accounting cycle for a sole proprietorship, which we have already studied in 11th standard. Now, we will compare the accounting cycle for partnership firm. So rest of the things remains the same, and the journey till profit and loss account, preparation of profit and loss account remains the same. But once we have prepared the profit and loss account, which discloses the net profit, then we prepare an additional account that is known as profit and loss appropriation account. And the objective of preparing this profit and loss account is to show the distribution of net profit. Because in sole proprietorship, there is only one owner. So whatever loss or whatever profit has been earned by the business gets directly transferred to the owner's account or the sole proprietor's account. But here, in case of a partnership firm, there are two or more than two people who are responsible or who are entitled to get their share in profit. So how that profit is being distributed among the partners, that is what is shown in the profit and loss account. And once the profit and loss account is prepared, profit and loss appropriation account is prepared, we go to the final step, that is preparation of balance sheet, which again discloses the financial status of the business. So if we compare the accounting cycle for sole proprietorship with the accounting cycle for partnership accounting, the only additional step that we need to do is preparation of profit and loss appropriation account, which shows the distribution of net profit or net loss. Now, there are some special aspects of partnership accounts. Accounting treatment of partnership firm is similar to that of sole proprietorship business, with exception to the following aspects. Number one, maintenance of partners' capital account. So in sole proprietorship, we don't maintain partners' capital account separately, but for in partnership accounting, maintaining partners' capital account is very essential and very critical. Distribution of profit and loss among the partners. So in sole proprietorship, we don't do any distribution of profit. It is directly transferred to the partner's capital account because there is only one person having the claim on the profit earned by the business. But in case of partnership, there are multiple people having their claims on the profits earned by the partnership firm. So in order to make sure that the profits or losses are distributed among the partners as per the provisions of partnership deed, the distribution of profit and loss needs to be done using the profit and loss appropriation account. Adjustment for wrong appropriations of profits in past. At times, due to some error or maybe due to change in partnership deed or provisions of partnership deed, uh, some adjustments may be need to done retrospectively. So the adjustment of wrong appropriation of profit and loss done in the past needs to be done in partnership accounting. Then reconstruction of partnership firm. Reconstruction of partnership firm can happen in different scenarios. First one, admission of a new partner. So there are two partners who are already carrying out a business in partnership and they are sharing their profit and losses in an agreed ratio. They have uh, agreement in terms of how much capital needs to be contributed and all. But if a new partner, a third partner is entering in the partnership firm, then the entire equation will change. The equation will change in terms of the ratio in which the profit and losses would be shared, the amount of capital contributed in the partnership firm and all. So whenever there is a change in the structure of partnership in terms of the profit sharing ratio, in terms of the capital contributed or any other thing, it is known as reconstruction. So reconstruction either can happen on the basis of revised provisions of partnership deed without any admission of a new partner, or at the time of admission of a new partner, or at the time of death or retirement of an existing partner. So these are some of the scenarios in which the reconstruction of partnership form may be required. Then dissolution of partnership firm. When all the partners decides to move out of the partnership firm, then the partnership firm may come to an end. So at that point in time, how the assets would be disposed of, how the liabilities would be paid off, uh, all those things needs to be done. So that is known as dissolution of partnership firm. So always remember, there is a dissolution of partnership and dissolution of partnership firm. So dissolution of partnership means the existing partnership coming to an end and a new partnership agreement taking place of the old partnership. But dissolution of partnership firm means the entire firm is getting dissolved. So the dissolution of partnership may or may not result in dissolution of partnership firm, but the dissolution of partnership firm will always result in dissolution of partnership. Now, we spoke a lot about profit and loss appropriation account, the account which is prepared to show the distribution of profit and losses. So let's talk about what some of the features of profit and loss appropriation account. The first one is it is prepared after preparation of profit and loss account. Hence, it can be considered as an extension of profit and loss account. So we cannot prepare the profit and loss appropriation account without preparing the profit and loss account. And in profit and loss appropriation account, we simply show how the profit and loss or losses of a partnership firm is being distributed among the various partners. So it can be considered as an extension to profit and loss account. It is prepared only by partnership firm. So this is very unique feature of profit and loss appropriation account, because the profit and loss appropriation account is prepared only and only by partnership firm and by not any other type of business undertaking. The profit and loss account falls in the category of nominal account. Then it shows how the profit for the accounting period is distributed among the partners. Entries in this account are made given effect to the partnership deed and or the Indian Partnership Act of 1932. So the profit and loss account is always prepared in line with the partnership deed, because whether to provide interest on capital or not. If yes, then at what rate? Whether to charge interest on drawings or not. If yes, at what rate? Whether the partners are supposed to get any salary or commission. Yes or no? If yes, then how much? Whether to provide interest on at what rate the interest to be provided. uh, to the partners on their capital, drawings, and all these things. And finally, in what ratio the profit and loss should be distributed among the partners. All these things are mentioned in partnership deed. So whatever entries you will make in profit and loss account, that would be in line with the partnership deed. And if the partnership deed is not there, then the entries would be as per the Indian Partnership Act of 1932. And there can be a third scenario where the partnership deed is covering some of the points related to the entries of profit and loss account, and the partnership deed may be silent on some of the entries related to profit and loss account, profit and loss appropriation account. So in that case, you will have to consider both the partnership deed as well as the Indian Partnership Act of 1932 while preparing the profit and loss appropriation account. Let's have a quick look at the format of profit and loss appropriation account. So it is more or less like your trading account or profit and loss account. It is again prepared for a year or a accounting period ending on. So it is again prepared for a period, not on a specific date, unlike your balance sheet. It has got two sides, that is debit side and credit side. On credit side, we record all the incomes or the losses transferred to the partner's capital account. Whereas on the debit side, we record all the appropriations against the profit. So salary, commission, interest on partner's capital, if any amount is transferred to the reserve, and the share of profit transferred to the partner. So this is a sample or a specimen of profit and loss appropriation account. Now, let's have a quick comparison between profit and loss account versus profit and loss appropriation account. So first is the stage of preparation. The profit and loss account is prepared after trading account and hence starts with gross profit or loss disclosed by the trading account. Whereas the profit and loss appropriation account is prepared after preparation of profit and loss account, and hence it starts with the net profit disclosed or the net loss disclosed by the profit and loss account. Objective. The objective of profit and loss account is to ascertain the net profit or net loss earned by the business during the accounting period. Whereas the profit and loss account is prepared to show the distribution of profit or loss among the partners for the accounting period. Opening and closing balance. The account, profit and loss account, neither have an opening balance nor has a closing balance, because in the we use the balance of trading account for that particular accounting period as the opening balance for profit and loss account, and it is closed during the same year by transferring it to the partner's capital account. Whereas the profit and loss account may have an opening as well as a closing balance. How? That is something we will discuss in subsequent sessions. Charge or appropriation. By charge, what we mean is something that we must pay, whether we suffer a loss or we earn a profit. Whereas appropriation means distribution. So all the expenses that we have incurred in during the accounting period, we must record it in the profit and loss account, and recording of those expenses are considered to be a charge, because you don't have a choice whether you want to pay those expenses or not. Yes, we follow the accrual base of accounting and we may record some transactions and show them as liability, but we don't have a we have a choice in terms of whether to pay them now or pay them at a later stage, but we don't have a choice in terms of saying whether we want to pay them or not. So that's why expenses debited in this account are charged against profit. That means all the expenses that we record on the debit side of the profit and loss account will reduce the amount of profit. Items debited to this account are appropriation of profit. We are talking about profit and loss appropriation account. So if we have profit, we will give a share in profit to the partners. If we don't have a profit, we will not give share of profit to the partners. We will not transfer anything to the reserve. So this entirely depends on the amount of profit that we have earned. So we have a choice here whether to give a transfer some amount to the reserve funds or not, whether to what is the amount that we need to give to the partners as share in their profit. So that's why it is known as appropriation or distribution. Partnership agreement. For preparing the profit and loss account, we don't need partnership deed or partnership agreement, except for interest on loan from partner. And even if we don't have a partnership deed or the partnership deed is silent about interest on loan from partner, we have the standard rate of 6% suggested by the Indian Partnership Act of 1932, at which we can pay the interest on loan by a partner to the partnership firm. But in order to prepare the profit and loss appropriation account, we use the partnership deed or partnership agreement as a base. And if not, then we will have to follow the provisions of Indian Partnership Act of 1932. Matching principle. Matching principle means matching the revenue and expenses for the same year. And this is the concept which is followed while preparing the profit and loss appropriation account. Whereas the matching principle is not followed while preparing the profit and loss appropriation account. So these are the 6 bases on which you can compare the profit and loss account with profit and loss appropriation account. Now, we spoke about charge and appropriation. So let's understand these concepts a little bit in detail, because this will keep on coming again and again. So when we talk about charge against profit versus appropriation out of profit, if we talk about nature, it indicates expenses to be deducted from profits while calculating the net profit or loss. Whereas appropriation out of profit means it indicates distribution of net profit to various heads. Recording. When we talk about recording, all the charges or all the expenses that needs to be matched, that needs to be recorded are recorded in profit and loss appropriation account. Oh, sorry, in profit and loss account. Whereas when we talk about appropriation out of profit, all the appropriations out of profit is recorded on the debit side of profit and loss appropriation account, whether it is necessary or not. All the charges, it is necessary to make charges against profit even if there is loss. As I told you earlier, we don't have a choice. We have a choice in regard to whether to pay those amounts or those charges now or in the following financial year or accounting period. We have only that choice, but we don't have choice in terms of whether we should pay it or not. Whereas appropriations are made only when there is sufficient profit. So if we don't have sufficient profit, we will not be transferring anything to the reserve account, or if the amount of profit is not very high, or rather, let me put it this way, the share of profit each partner will get is not pre-decided. So for example, if we have 100 rupees of profit and there are 2 partners sharing profit and loss equally, then both the partners will get 50 rupees. So in the partnership deed, we will say that the partners would be sharing profit and losses in the ratio of 1:1. We will never say that partners will share the profit and losses as rupees 50 is to rupees 50. So appropriations are made only when there is profit, or the appropriations are restricted to the amounts of profit. If we talk about examples, then interest on partner's loan or rent paid to a partner. So as per the if the partner, even if the partnership deed is silent about at what rate the interest on partner's loan would be provided, you have to provide interest on loan provided by the partner to the partnership firm at the rate of 6%. And even after paying that interest, the profit becomes the net profit becomes net loss, then also you will have to pay. If any partner has given any office property, say building or machinery or car or something, to be used by the partnership firm with an agreement that rent would be paid to the partner for using that particular asset, then the partnership firm must pay that rent, even if they incurred loss after paying that rent. Whereas if we talk about the appropriation, interest on capital or partner's salary. So interest on capital or partner's salary would be paid only if there are sufficient profits. And if there are not sufficient profits, then it is not mandatory to pay the interest on capital or partner's salary. But yes, there would be some provisions in terms of if there are not sufficient profits, then how to deal with it. We will discuss in the subsequent chapters. So with this, we come to end of this video. And in this video, we have spoken about the introduction of human activities or different types of business undertakings. We have discussed about what is partnership and what are some of the common provisions or ground rules related to accounting for partnership. So thank you very much for now. And in the as discussed earlier, in the following video, we will talk about treatment of capital and treatment of drawings.